Welcome, everybody. I think it's wonderful to have such a great turnout on such a turbulent week, and we're very honored. We've got some really distinguished investors here today, and I sincerely hope and believe that we will have a lot of dialogue and participation that will make it much more interesting for all of you. So we'd love to hear from you. Many of you have specific knowledge in certain areas of energy, of shipping, of other areas of investment, and we're certainly trying to open up some ideas this morning, and we'd like to hear back from you. I have with me my team, who you will see during the day: Frederick Mukata, Francis Goulet, Justin Chan, and Alice Wang. Will be introducing our distinguished roster of speakers. And I'm just going to make a brief introduction and some of the leading themes and ideas that we'd like to share with you. We love bear markets. I think it was Warren Buffett who said that he got very overexcited in a rather graphic way. He said, it's a great time to buy when everybody's fearful. And I think that you might call it the extraordinary delusions of electronic crowds, in the words of the famous 19th century volume about markets. And in particular, those crowds who are at a greater distance from the epicenter called China know much less about the reality of what is happening on the ground. I don't need to say that to all of you. Many of you know China much better than I do. But I think we constantly talk to our Chinese sources and friends and understand the complexity which is really China today and how large and important its economy is. It can be described as a continental economy like the United States, and there are so many regions and so many sectors that are growing at different paces. So in the last year, we've had a fun time. We launched our business really in April, and from April to September, we had, I guess, a 40% fall in China, about 25% fall in Hong Kong. So it was a great time to start, actually, and my team were tested tremendously, and we really drilled down to the values and the basic principles of the companies that we liked. And I think that was a valuable experience. And so we have much more conviction about what we own today than I think we did a year ago. And having started really with a defensive view of the world, a sense of the oncoming deflationary wave, I was conscious of currency risk. I was looking at hunkering down in Hong Kong, because Hong Kong, after all, is a US dollar base. We have great companies here with great dividend yields, and I thought this is a place to conserve capital. As the summer unfolded and the China market collapsed, we traveled twice to Shanghai, and we started to find some really interesting companies amidst the rubble. And we wanted to highlight some of those today. Unfortunately, we couldn't get the speaker from one of our favorite companies, which was China Lodging, the hotel chain. That was one which I saw with Scobie last summer in Shanghai. Great play on Chinese tourism. We have a speaker from NOAA. William Marr will be our first speaker. And NOAA is a great example, too, of the wealth management business which is growing in China. And again, as the year unfolded, I'd go to New York and Boston and talk about China, and I realized that they were too frightened to take their hands out of their pockets. When I went to Shanghai, they were asking me, how can I invest in America? So I realized that this capital flow is reversing. NOAA is in the front seat of this show, and I think that this is an important trend which we see developing in the next 5 or 10 years. So we have to be extremely nimble now. I think last night we were talking over dinner about the peculiar moment of history which we're living through. And John Budden, who invited me to Ottawa a month or so ago, said to me, this is the end of the debt super cycle and the Kondratiev wave. What does it mean? Even my Chinese friends say it's the end of one cycle, beginning of another cycle. And the transition between the two is a very choppy, very volatile time. Very difficult to see what is emerging in what will undoubtedly be an exciting new era of growth within 2, 3, 4 years. But right now, it looks like we're in creative destruction with the oil price plummeting and so many secondary effects of that on capital spending, on bank loans, on economic growth, on trade, and on currencies. So that's the overwhelming fact, I think, for us to grapple with as investors. And again, I come back to the risk of currency devaluation being our principal concern over the last year. I'm not meant to market, and I don't intend to, but I just want to share with you some of our thoughts and some of the ideas that we've come up with. We are actually quite heavily invested in Hong Kong and China. We don't own any A shares. We don't own any H shares. We own typically e-commerce companies listed on the NASDAQ and China tourism type plays. And in Hong Kong, we have a fairly defensive high yield portfolio. This year, I anticipate that we will grow India and Japan and gradually shift away from China. But our themes and sectors, as I say, are Chinese tourism, internet and e-commerce, education, wealth management in China, healthcare in the region. And from the beginning, I said we'll have no property, no mining, and no energy. And I think that call alone saved us a great deal of money if we could only make the money on the other side by keeping out of the sectors that were falling. So the deflationary trend is the one thing which we have to focus on. And I will come back to this because I think we have to use history to understand how to survive this era, how to prosper in this era, and where the opportunities will be. And it's not very easy to navigate. As I said, the oil price fall is the overwhelming factor. And at the beginning of last year, we said oil is coming down. It's fantastic news. It's going to benefit India. India's cut its current account deficit from 5% to 1%. China, Korea, Japan will all benefit. It's great news that the oil price is coming down. Well, what surprised me and perhaps others was that this saving wasn't passed on to consumers. It didn't appear in corporate profits. It's actually been swallowed up in a diminishing total value. And so I think that's a very difficult thing for us to calculate where this goes forward. At some point, the oil price bottoms out, and I think we will start to have the 18-month lag jumpstart to economic growth. So I do believe that it will come through. I don't think we're in a permanent decline. But at the moment, we haven't really seen this benefit, even in the United States, where motorists are paying under $2 a gallon. It's not feeding through to consumer spending. People are saving. So Asia should be a major beneficiary of this, and I think it will become more visible. In terms of this emerging new landscape, clearly technology is going to play a very important role, and we see, obviously, the internet effects. We see, I think, electric cars and solar and these things, which may or may not be a big impact on oil companies, on auto companies, and it's very difficult to time them. But I think something is happening, and we can't be unaware of it. And maybe banks will also be subject to this technological change. So we try to look at every investment and say, is there an unforeseen risk here? Is there a technological impact and creative destruction in this industry? And I've highlighted Uber, Airbnb, and Amazon, and we wonder who will be next in this trend. So I think that's a question worth asking. I'm sorry to say that we're quite negative on property, and I know it's the favorite form of investment for everyone in Hong Kong, but I think that what we are now going to see is the next phase of deflation, and the debt deflation cycle will play out in property in China and Hong Kong. So I think by the end of, say, 2017, 2018, we will see much lower prices. And we have to think that through and what impact that has on the banking sector and so on. We've seen the first wave of Chinese wealth coming out of China, and that went into property. The second wave, I think, will be much more diversified. It will go into equities. We're seeing, like yesterday's deal, when Wanda bought legendary entertainment in Hollywood. This is the kind of deal which we're going to see more of, buying brands, buying consumer companies in the United States and Europe. So I don't think that bricks and mortar are going to be the major theme of the next 2 years. I think it's going to be much more liquid investments. We've seen a tremendously positive change in Japan in the last 3 years, really, since Abe came in, and we've gradually upped our weighting in Japan because we've seen so many of our companies there really change their corporate governance, raise their dividend payouts, and improve their transparency. So we're bullish on Japan relatively, and I also think it's very interesting how the yen is acting at the moment, and there's a sense that we may have reached bottom with the yen, and we're looking at a more profitable outlook for Japan this year. Lastly, healthcare, which is something we spent a lot of time looking at and had very great difficulty in finding really world-class companies in Asia that met our criteria. But we're still looking at hospitals as well as medical equipment companies and drug manufacturers. We've had some disappointments, for example, in India this year, where we thought we'd got some great companies. There were licensing difficulties, and so we're cautious on the stock selection in that sector. I think one of the things that we are aware of is there's a general slowdown, and therefore people will pay a premium for higher growth in regions where they're experiencing 6-7%. If the direction of China is coming down from 7 to 6 to 5, then people will be cautious. If India is holding up in the 7 to 8% growth rate and earnings growth in India is sustained, then I think India will command a premium. So we tend to feel that the emerging market category is no longer a useful one for investors. But if you take a regional approach, and that's what we talk about the Indian Ocean area, there is going to be demographic growth, consumer growth, and a lot of good opportunities. And we have a wonderful partner in Asit Kotari, who may say a few words at the end of the morning. He's based in Bombay with a team of 4, and they do several hundred company visits down there every year, as we do in the rest of the region. And I think that he's beaten his mid-cap benchmark by twice this year, and we really see that mid-cap area in India as being very exciting. When you think about what's happening in the rest of the world this year with the presidential election in the States and some uncertainty there, Europe really having a lot of difficulties. I expect that Britain may well vote to get out of the European Union this summer. Consequence will be a weakening euro. All of these things going on in the Middle East. Asia looks stable. It looks attractive in terms of currency and growth and opportunity. So I think there's a relative game here, which when we talk to our American clients is clearly favoring the Asian region. It's no longer an emerging market basket that they're looking at. I think Asia will be the main area, and because of the commodity price decline, that will also favor that investment decision. I referred earlier to the historical perspective on this, and one of my heroes is Maynard Keynes. Although he was quite critical of my great-grandfather at Versailles. He wrote several books on the consequences of Versailles, the consequences of the return to the gold standard. He was a very successful and occasionally unsuccessful currency speculator in the 20s. But when the deflation hit in the 30s, he took a very calm, measured approach for King's College, Cambridge, and tripled their portfolio by buying utilities and having a really good stock selection. So I found that very interesting that he was such a successful investor during a period when many people were being wiped out. And like the 2010s, the 1930s was a time of falling prices and high unemployment and low economic growth. So I think we have to learn, and the 1870s was the same. You had also tremendous technological growth and improvement in that era. So I think we should look at these eras and try to see how great investors navigated them. Gold could be interesting. My first take on last week's action was that everyone is beginning to doubt the infallibility of central banks. And the question is, what will they do next? And at some point, people are going to begin to accumulate gold because it's a relative value. It's done so badly since 2010 or 2011, and I think now there is a desire for something more stable. And indeed, as the Chinese see the renminbi weaken, there will be more gold purchasing from China. So I just thought it was interesting to look at the longer-term development of foreign exchange reserves and to reflect that China still has a huge financial cushion there, and that the renminbi, far from being weak over a period of 10 years, is in fact one of the strongest currencies in the world. I don't need to share that with you, you all know it, but I think that for our international investors, it's really important to highlight. And the foreign exchange reserves are still extremely important. So I think that over the next few years, cash will be king, and he who owns the gold has the power, and so we shouldn't diminish that factor. So we just highlighted 2 or 3 of the companies that we found this year. I mentioned this hotel chain in China, which has 2,500 hotels, occupancy rate of 90%, growing about 25%, just increased their dividend last month, and we were very impressed with the corporate governance of this company based in Shanghai. And again, private sector business, service sector, tourism play, just the kind of thing that we are looking for in China. And in India, we also found a very similar business called Make My Trip, which again is listed in New York, but is perhaps the best play on the Indian tourism sector. And they have done very well recently since C-Trip became an investor. Really, we didn't find very many medical companies in Asia itself, but as in the past, Australia has been a great place to find pioneering medical businesses. We used to own a lot of Kochlear. We've taken a position in Nanosonics, which is refrigerating medical devices, and that's doing very well. And then recently, Francis got me into this company in Japan, which is also a beneficiary at the end of the one-child policy and of the Chinese tourism there. So again, a well-run Japanese business benefiting from low yen and Chinese visitors to Japan. So that's just probably a flavor of some of the mid-cap, small-cap companies that we're highlighting in our investment portfolio. So I think what I'd like to do at this point is to introduce William, Chief Investment Officer of the largest independent wealth management platform in China, but it's really one of the key Shanghai-based businesses which is introducing professional fund management in China. Over to you, William.
Thank you. Thank you, Robert.